Hi, I want to welcome you especially to this video, and in this video I'm going to be showing you beautifully all you need to know about market structure. Now, the reason why many traders are getting it all wrong and probably losing in the market is because they don't understand market structure, and that's why I took time to do this video and make it sufficient with sufficient information and knowledge, so that after you've seen this video you understand what market structure is completely and you can be able to apply it while trading. Now, one thing I want you to understand is when you are trading and you want to make so much money in trading, then you must focus on where the big players, the financial institutions, the hedge funds, those people who engineer liquidity, focus on where they come into the market. That's actually where the money is. I and you as retail traders, we do not have much capacity to cause the market to move. There are people who move this market. They're called the big players, they're called hedge funds, they're called market movers, and they engineer liquidity. And part of what I'm going to be teaching you in this video named market structure is how they engineer this liquidity, and I want to show you how you can have a unique mechanical hedge fund strategy that will make you millions of dollars and make you so much money in the market, help you win prop accounts, help you grow that small accounts to big accounts, just keep you profitable. Many of you who haven't been profitable all this time, I'm very sure that after you see this video and you practicalize it and you put it to work, you will definitely be very profitable. So quickly, let me just show you. Now, let's just look at this quickly. Okay, so I'm going to be talking to you about market structure, and there are some few things I've put down here for you. Okay, so now when you're talking about market structure, this is what it looks like. If you may look at it in drawings, like what the textbooks sometimes would show. Now this is more like an entry point, and so price goes, you're seeing it already. So let me just pick a tool that was used to draw that and just draw another one for you. So this thing here, I'm drawing it again. So this is markets taking this level and creating a new higher high, and lower high, and a new higher high, and lower high, and a new higher high, and lower high, and a new higher high, and lower high. And each time markets create this kind of structure, it is called a trend. Okay, so a trend is when markets continuously keeps going up, like on a bullish trend, and it keeps taking out the it keeps breaking structure, taking out the previous higher high to create new higher highs, and new lower highs and new lower highs. Okay, and that gives you a trend, or a bullish trend, or a bullish structure. So now let me show you the bearish structure. So it's vice versa, or vice versa. So just the same thing that happens here, but this time around on the downside. So price comes, takes out the previous low and creates this new low, and then creates this higher low, and creates this lower high, and creates this new higher low, lower high, and create this lower low, and create this lower high, and create this lower low, and create this lower high. So this case is it's a bearish structure, or a downtrend. Okay, so these are the two kinds of structures that you find when you're dealing with trends. So there are two trends, that the bullish trend or the bearish trend. And then the final one, which I'm just going to show you here, is the range. Okay, so I'm showing you market movement. So market moves in only three ways, or let's just say two ways. Let's put trend into one, and let's say a bearish trend, the bullish trend. Okay, and then when we come to range is the second. So sometimes market is ranging, and what it means for market to range is that market stays within a confined position, like let's say in a rectangle like this. So you find markets, instead of pushing up, it just come touches and repeats its touch, and keeps giving double bottom, triple bottom, four pull, fifth, just like that, before suddenly maybe a breakout to the upside, or maybe a breakout to the downside. That's what is called a range. So basically, in case you don't know how the market moves in just two ways. Either it's a trend, a range. Most times the range movement is considered a consolidation. Okay, and after the consolidation, it's going to give you either a pullback, a reversal, or a continuation of trend, or a change in market structure. Take note. So that means what the range and the consolidation brings you is change in movements of the market, change in structure. It could be change in structure, it could be change in movements, it could be change in trend. So we'll just take note that it is a consolidation that brings about a different move in the market. Take note of that. So anytime you find price consolidating like this, most times it's either trying to gather momentum, liquidity, and decide where will be the next move in the market. So that's all on market movement. So I'm going to take you from market movement into the structure. Now let's talk about the strong structure and the weak structure. So when it comes to the market, any structure that takes out the previous structure, any low that takes out the previous structure, which is like take for instance this low here takes out this higher low, right? Yeah, higher low, then this low becomes a strong structure. And for you to trade correctly, when you're trading market structure correctly, you are to trade from the strong structure to the weak structure. Take note of that. The strong structure holds price more and takes you to the weak structure. For those of you who don't understand price action, this is what price action is about. You trade from the strong structure to the weak structure. The weak structure, most times price just gets there and break the weak. That's why it's called the weak structure. No, the weak structure. The weak structure is usually that particular high or low that was taken out by the previous low or high. Take for instance, this takes out this, then this becomes a strong structure, this becomes a weak structure for the bullish trend. Now when it comes to the bearish trend, if this high takes out this low, then this high becomes a strong structure and this becomes a weak structure. Okay, so take note, you have to trade from here to here. So whenever there is this kind of change in market structure, then the next thing you should be looking out for is for this pullback, and the pullback brings you into a POI, and then you begin to find entry. That's the best way to find entry in trading market structure correctly and like a professional. All right, so now let me talk to you quickly on. Okay, I've just spoken to you about strong structure. Then I just want to talk to you about the bearish structure. I've already told you bearish and the difference between bearish trend and bullish trend. So when it comes to structure, we have bearish structure and we have bullish structure. So this is a bearish structure. Why is this a bearish structure? Because this previous lower high takes out this previous lower low, like I told you in that previous explanation here when I was telling you how this trend was formed. So it can be called a trend and also it can be called a structure. Okay, now price goes from the weak structure to the strong structure, just as I've told you. Then we have the swing structure and the internal structure. Okay, we have the swing structure and the internal structure. Now what you need to understand is that this drawing here is more like what you see in the textbook. What actually happens in the market is not really what you see in the textbook. So you get to see things like this. Okay, when you look at the chart, you get to see things like this, and suddenly you get another one like this, and then okay, so you keep seeing internal structures that facilitates, you know, pullbacks. And this is actually what the market looks like, not this. So if the market actually looks like this, then it becomes too easy to predict, but this is actually what the market in real sense actually looks like. So in that case, since that's what the market look like, then we must identify the swing structure and the internal structure. So when we're talking about swing structure, we're talking about the previous, either the previous high, okay, that facilitated the break of structure. Take for instance, if you look very well, you see that this high based on this drawing that was drawn just now by me, okay, is what facilitated this break of structure. In case you're not seeing it clearly, let me just point it out for you so you can see it clearly. So there's a break of structure here, and it's basically that high that has been marked just now by me, okay, this high that pushed this break of structure before this pullback is facilitated. So what happens is such highs that facilitated the break of structure becomes the swing high, you know, and the new lower low where the pullback, you know, moves from, or the trend starts, the internal trend starts forming from, becomes the swing low. So this can be, sorry about that, this can be regarded as a swing high, okay, can be regarded as a swing high, and the one underneath just here can now be regarded as the swing low. So that's those are the two basic, the swing high and the swing low. So the swing high and the swing low both gives you the swing structure. So the swing structure has the internal structure, and the internal structure most times is the structure that is formed for pullbacks and for price to either retrace or change market shift or structures. Okay, so now to identify swing structure, I've shown you, you just must know that there is a swing range, of which if you look, you see this is a range, just like what I taught you what range is. But this swing high is what's where the pullback here stopped, and this swing low is where this pullback here began. So it can be called swing structure, it can be called swing range. I'll be explaining to you how to understand the internal structure. Now what you need to know is that the higher time frame swing structure is what the directional bias is. Okay, that first of all understand that, then you understand that the internal structure is also going to have its trend. Okay, so what happens is, so since this is the high that facilitated this break of structure, then what it means that this is a protected high, okay, and also this is a very strong high. So what happens is whatever structure is formed here like this, it's an internal structure, of which, as you can see, it's a downtrend. Okay, and most times we don't trade this because this is where the big players, you know, engineer liquidity and takes out the retail traders. This is actually where we trade either we're trading this because of we're looking at for high probability setups, okay, that will give us the entry. Okay, so let's say yeah, of course you could trade this after the retracement, like from here, but not from this side because of low probability setup. And you could trade this because the trend is clear. But the only time you're able to trade this internal structure is when you've been able to confirm that the internal trend like this has been shifted. Take for instance, this previous low is now taken out by this new low, and then it keeps giving you new lower low and new lower high, and then you know you're in a downtrend. And if it shifts again peradventure and it starts giving you new higher low and lower high, then you know that the structure has changed. So that's basically how to understand the internal structure. But just take note that the internal structure is not the real directional bias. It is actually what facilitates the pullback. Okay, so now let me take you straight to market structure shift. So there is market structure shift on the higher side if you look at the swing structure or the swing range in the higher time frame, and there's actually market structure shift in the internal side. So for the higher side, take for instance, this break of structure is actually what we call the market structure shift. Take for instance, once this break of structure is occurred, then we know that we're going to be expecting price to just come into a point of interest and begin to go down, because we have broken structure telling us the price will now begin to go down from a strong high now to a weak low. Okay, so that on its own is market structure shift. And then in the internal part, just like I explained to you, when we're expecting this pullback, there's going to be an internal pullback trend, which once you see a market structure shift on this side, you know that this trend here has stopped and there is a new trend formed here that can give you your bullish move. Now let me talk to you about the hedge fund strategy that can help you make so much money. It's helped me make so much, and from being a one figure, of course, 1 figure to 2 figure, to from 2 figure to 3 figure, and I've been able to deviate from that into a 6 figure fund manager and trader in the industry. And that this hedge fund strategy will make you so much and help you to be able to grow that account, win proper accounts. It can help you win proper accounts, give you the sniper moves and the sniper entry. Why is this important? Stop being trapped like the retail traders. Yes, of course you're a retail trader, but you can understand where the hedge funds and the market movers come in and trade like the hedge fund traders, and that's the best path that you need. First of all, you have to identify the bias, and the bias comes from first on the higher time frame structure and liquidity. So this is it. This is what it looks like, just like what I explained before. So from the higher time frame, you're going to have a break of structure. Of course, the facilitated pullback that pushed the break of structure just after this liquidity is being swept. This break of structure is what tells you the movement. Now, catching from this point to this point is the sniper entry. But all of these is noise. That's price coming to give this internal trend, then the shifting structure to now facilitate this move is what we call the internal move, or noise. This is the part where there's noise. So as a hedge fund trader, all you need to do is to just wait for price to come into your point of interest. Take for instance, you already see that this is a liquidity sweep which gave the break in market structure. This is a protected low and a very important low. Okay, and such kind of lows would help you to be able to catch the sniper entry. So anytime price comes into that particular zone, which is what you can see is identified here, you begin to look for your sniper entry. So you could actually trade this internal movement, but you must be very careful. You should know that it is low probability setup. The high probability setup is when you understand where the hedge funds will be coming in, like the one who engineered this break of structure, and they will be the one engineering this. So you already know that because the break of structure was engineered from this point. Anytime price gets into this zone, that's this demand zone, and gets it mitigated, you already know that that is your point of interest, and that's where you'll be considering going. So first of all, when you're dealing with this strategy, like I said, the hedge fund strategy, the first thing you must take note of is, let me take this out so you can see clearly what I'm talking about. The first thing you must take note of is, sorry, I just want to quickly take this all out so you can see it clearly. Alright, so let me just reduce the size so it can maintain this space. So the first thing you're going to look at is the swing structure. You must know the low and the high. As you can see, this is the swing high and this is the swing low. So from the higher time frame, you'll be able to understand the swing high and the swing low, where price pushed from to break structure becomes your swing low, and your strong low, your protected low, and the weak high, where price began to pull back to come into your point of interest, becomes your high. Sorry about this. This is typo error. So this is supposed to be typed as low. I hope that is clear. Then your lowest structure that swept the liquidity gave you the break of structure is your protected low. The structure means nothing without context. Okay, then your high probability setups come from this point. Any other one is low probability, except you have a market structure shift. Then you can go shorts on the internal bearish move. Then identify the liquidity zone after the bias. Okay, so after having understood the bias, okay, this is an uptrend, or identify liquidity, which is here. Okay. Now, places where the retail trader will most likely enter and get trapped, you must identify that as liquidity sweeps. That's also it's within the internal structure. You're going to find double bottom, things like double bottom. You're going to find things, just in fact, basically those places where the retail traders will be entering. Identify those liquidity sites, because that's where they're going to be engineering liquidity. Then identify trend line, because retail traders are going to be drawing trend line, and their trend line will serve as liquidity as well. So those shouldn't be your entry point if you are trading this hedge fund strategy. They are just basically where the big players will engineer liquidity. Then you must identify liquidity and structure shift, like I told you. Then identify the mitigated higher time frame demand zone and take the last internal lower high. Okay, then your break of structure that clears liquidity, I already told you about that. You must identify the clean displacement. Okay, this is it. And then your internal break of structures, I've already shown you that. Then your strong structure to the weak structure. So price will come from the strong structure to the weak structure, like I already told you from the beginning. This strategy only works when there is a high mechanical structure like this. So if you look at your chart and you're able to find a mechanical structure like this, that's when this strategy is going to work. So this is high probability setup. This is A plus setup, and it's going to make you a lot of money in the market. So anytime you find setups like this, don't joke with it. Fund that account, go in big time, use big lots. I'm just joking, but just take notes. It will give you a lot of money. Okay, now once I see these criteria checked in, like I just told you, then I'm going in time, full time, big time, no guessing. This is what makes the difference between guessing and gambling, and this works with forex, crypto, CFDs, synthetic stocks, and all manner of trading side that you can eventually think of. Anyway, all right, so quickly let me take you to the chart so I can just show you an example of what this I just explained to you would look like in the chart, and how you can identify it and take advantage of it. So quickly, if you look from this side, you will see clearly that something like that is being formed here already. So you see there is take for instance from this side, let's just look from this side. Okay, you see that there is a break of structure. Price moved from here to here. Take note of that. Okay, I just gave you the direct line, I didn't give you the internal structure because I wanted to see what I want to explain to you. So pay attention to this broke structure from this side. Okay, so any other thing you're seeing is internal structure. So all of this is internal structure. What you should pay attention is the move. Okay, so this is a huge move and this is a displacement. So what happens is, from this path you could just see that what engineered that movement is this demand zone. Okay, and then when price returned back into that demand zone, all you needed to do is to confirm your market structure shift. So this is the previous low in the internal structure, the previous lower high in the internal structure. Okay, that's facilitated the break of structure here, or rather structure shift here, because there is a shift in structure here. Okay, so the moment price broke it gave a shift in structure. Take note of that. And once that is shifted, then you already know that you should be looking out for your entry, your sniper entry, your hedge fund strategy entry, which I just explained. Okay, so what do? You just wait for price, having taken out that, to come back into the liquidity zone, of which you could see this is the demand zone. Now there are several demand zones here, but all you need to do is you read it from the beginning. So let's read it from the beginning. So this is where price came and began to pull back from this demand zone. What did it do? First of all, it shifted from this point. Okay, and what shifted from that point is this first liquidity zone. Okay, so that's this first demand zone. And then what did price do? When price pushed out from it, it came, mitigated it. So this demand zone will most likely not hold price again because it's been mitigated. And then another one was formed here. If you look closely, it was formed here, of which you could actually add it to this because they're so close. Okay, and that on its own can actually give you that facilitated entry. So all you need to do is you're going to just look, not that you're just going to go in immediately. You are going to still have to confirm that that's going to continue, price will continue going up. How do you confirm? You're just going to make sure that your bullish confirmation is given to you on a lower time frame before you know that you're going to enter that. So the moment price got into that zone, if you go to a lower time frame, which is the 4-hour time frame, the moment price got there, if you get into a lower time frame, you see that price still came back. You see that? So, well, if you look closely, you see that the moment price mitigated it, you see that price still came back there. So you could actually pick it as your entry. The moment you see that price has pushed up and returned back, that becomes your sniper entry confirmation. So you know that your bullish or your conservative confirmation. For the aggressive confirmation, since you see that this is the demand zone, you can decide to say, okay, once price gets into this demand zone, I'm going to enter immediately. Now, the reason why we go aggressively is when we don't want price to leave us behind. Then we only go conservatively when we just want to be very sure. We don't, especially when you know what you're risking in the market before you go in. But this simple, and your stop loss should just be just somewhere around this previous liquidity that was swept, and you just know that that's a protected low and price may never get down. Now this particular strategy made me filthy rich through the prop trading. Okay, because with these I've been able to pass 200k accounts up to about 5 of it. Okay, and $1 million funded dollars, $1 million funded, 6-figure trader for the prop firms that I manage. Okay, so I manage $1 million prop accounts through this strategy, and this strategy can give you that which you're looking for in the market. I caught a move like this and I passed most of these accounts just with one entry. You too can do it. So with this video, I'm sure that you will get it. With all you've seen in this video, all I want you to do is practice it. Now let me tell you, you won't get it once and just immediately just after you've seen the video. You won't get it. I must tell you, before I mastered and perfected market structure and this thing I just taught you in this video, I have to watch the videos many times, okay, to remind myself of this strategy, remind myself of how the structure works, remind myself so that I can be able to get used to it. Some of you may need to unlearn what you've learned before, because that which you've learned before has not kept you profitable. That which you've learned before has made you lose so much, blow different accounts, make you keep on losing proper accounts, make you not pass the challenges and the challenging phases, make you not be able to grow that little bit, that little account, and has put you in one position for too long. You will need to unlearn that. And let me tell you, you need to see this video again and again and again, and as you see it, you practice it. And please, you can practice on demo, but I must tell you, if you practice on live accounts, then you're going to see more results, because your emotions has to be checked, your emotions has to be in it. You have to be able to confidently say, oh, this is a mechanical engineered strategy that I learned, okay, from Chiude Victor. Let me put it to work, let me see what it can produce. You have to be able to put it to work and see yourself hit the stop loss and hit the take profits and flip the account and make the money. That's how you can perfect this skill. Okay, I'm going to see you in my next video, where I'm going to be talking to you more and giving you more insight about the market. Meanwhile, if you want me to coach you, you want me to mentor you, then I'm available. I have one-on-one coaching, private class, general class. Just get on board on KFC Trading Academy and we got you from there, and we're going to teach you all you need to know about trading. I promise you, coaching and mentorship will help you get it right and save you from mistakes, getting burnt and being destroyed or humbled by the market. I'm waiting for you. See you soon.